Gold is approaching a critical liquidity zone right now, and smart money is actively preparing their next move. My focus today is a high-probability long setup, but there's a strict condition that needs to trigger first. Most retail traders are looking at the wrong levels entirely. In today's explainer, we are looking purely at institutional order flow.
Let's cut right to it. My daily bias is heavily bullish. The primary draw on liquidity we are targeting sits squarely above the 4652.70 buy-side liquidity level. We are positioned for a massive bullish continuation, and I'm going to break down exactly how we plan to execute it.
When we look at the H1 timeframe, price is deep in premium and pushing into all-time highs. This external buy-side liquidity resting above 4652.70 is our ultimate target. It's highly vulnerable right now because of the strong order flow alignment we're seeing across the daily, H4, and H1 timeframes.
But here's the catch. Before we go long, we need to see one specific thing happen. We must see a sweep of the M15 internal sell-side liquidity resting right around 4635. The market has been leaving a trail of higher lows, creating a massive pool of inducement. Smart money is going to sweep that level to grab liquidity before initiating the real leg higher.
So here's the exact execution model. We're looking to buy in the discount zone, specifically between 4632 and 4636, targeting that external liquidity at 4652.70. Our stop loss will be placed securely at 4625, just below the local displacement swing low, to protect against a structural failure. This gives us a highly asymmetrical 1 to 3.2 risk-to-reward ratio. And remember, once take profit 1 is hit, you move that stop to break even.
Now that the plan is clear, we have to ask, why is smart money engineering price toward this specific objective? If you want to spot the intraday trap, you have to zoom out and find the institutional footprint. Taking a look at the daily dealing range, price completed a very deep discount sweep into the 39, 29, and 4,000 zone lows a while back, which sparked this sustained bullish displacement. We're currently sitting in the premium half of a massive range, and the broader institutional objective is clearly drawing price higher to fuel further expansion. This institutional expansion is crystal clear on the H4 timeframe. Notice the aggressive displacement. We're seeing almost zero meaningful retracement, which leaves behind a series of completely unmitigated bullish order blocks. The market is in pure expansion mode. Order flow is strictly under bullish institutional control.
And the macro environment aligns perfectly with our technical bias. The US Treasury is actively buying back long-term bonds, which severely weakens the US dollar. Combine that with unprecedented geopolitical sanctions on Iran, and you've got a perfect storm. As Scotiabank highlights here, capping yields creates a heavy burden on the dollar. And historically, a weakening dollar is a massive tailwind for a long position on gold.
You can see this momentum reflected across the entire commodity sector. Gold has rallied nearly 5% this week alone, completely outperforming most major assets. This aggressive rotation of capital into safe haven assets absolutely confirms our higher timeframe bullish narrative. But here's the problem. The market is sending a serious warning signal right now. Price is consolidating near the highs after an aggressive M15 expansion, and we have not seen a deep sweep of internal sell-side liquidity yet. Buying right now in deep premium without a pullback carries absolutely terrible risk. Smart money confirmation hasn't appeared yet. So, is this actionable right now? No, not even close.
We are only executing if we see this exact three-step sequence during the London or New York kill zones. First, we need a surgical sweep of that 4635 sell-side liquidity. Second, we want to see an M15 displacement back above structure, giving us our market structure shift. And third, we need price to mitigate the newly formed bullish order block or fair value gap.
Waiting for price to rebalance into our M15 fair value gap between 4632 and 4636 is the absolute crucial step before deploying capital. These gaps are literal footprints left by institutional algorithms. They act like magnets, pulling price back to fill the inefficiency before continuing the main trend. We want our entry right inside that rebalancing phase.
Once we get that internal sweep and the market structure shift confirms, this setup carries an 85% execution confidence score. Our baseline probability for a bullish move today is already high, but waiting for that specific liquidity sweep is what drastically elevates our edge.
This liquidity pool changes everything, because this is the exact scenario most traders are completely ignoring right now. You have to ask yourself,
Who is providing the liquidity for institutions to buy at a discount? This is where most traders get trapped. The retail mindset sees a massive weekly gain and blindly buys the premium expansion at the highs because of a fear of missing out. But the institutional edge is waiting patiently for that internal discount liquidity sweep. Smart money is going to drive the price down just far enough to trigger the stop losses of those early retail buyers. They use that exact liquidity to fuel the real move up to 46.52.
Now, we always protect our downside. This level becomes critical. If we get a clean H1 candle close below the 46.08 swing low, our immediate bullish momentum is entirely invalidated. If that happens, we kill the trade plan completely. That would signal a structural breakdown and a shift in institutional order flow toward much deeper discount arrays.
Let's do a quick recap of the institutional game plan. The daily and H4 bias remains firmly bullish. The narrative is a premium expansion, and we are simply waiting for a discount pullback into internal liquidity. Your only job right now is to wait. Wait for the sell-side liquidity sweep and the market structure shift. Your target is 46.52.70 and respect your invalidation level at 46.08.
If you appreciate this level of precision and enjoy institutional-style market analysis using ICT and smart money concepts, subscribe to ICT Market Theory. And if you'd like to trade alongside these setups, you can find the FXTM account link in the pinned comment below.
The charts are printed. The levels are set. The macroeconomic catalysts are already in motion. The only question left is whether you have the discipline to wait for smart money to reveal their hand, or if impatience will make you the liquidity they feed on. Stay focused, stick to the model, and trade safe.